Hello, I'm John A.G., and there's a strange feeling that settles in when the numbers keep moving higher, but the explanations feel thinner every time you hear them. It's the moment when you realize you're still calm, still functioning, still nodding along, yet something underneath no longer lines up the way it used to. Nothing is crashing, nothing is screaming for attention, and that's precisely why it feels unsettling. Because the system isn't breaking loudly, it's adjusting quietly while most people are still waiting for a signal that sounds familiar. For years, gold occupied a very specific place in people's minds. It was the thing you turned to when inflation ran hot, when wars broke out, when currencies wobbled. A hedge, a reaction, something defensive, something temporary. You didn't need to love it. You just needed to understand when it was useful. That understanding created comfort. It suggested that risk had rules, that stress came in waves, and that safety could be activated when needed. But what happens when gold stops behaving like a reaction and starts acting like a baseline? As prices pushed past levels that once felt impossible, the natural instinct was to look for the catalyst, the headline, the event, the reason that would justify such a move and, more importantly, signal when it might reverse. But the more you search for that single explanation, the more elusive it becomes. Yes, geopolitical tensions are present. Yes, government debt keeps rising. Yes, policy signals feel increasingly unpredictable. But none of those alone explain why gold didn't just spike, but stayed elevated, pushing calmly toward levels near $5,600 an ounce as if it belonged there. This is where psychological disorientation sets in. When an asset moves in a way that doesn't match the emotional tone of the moment, it forces a reassessment. Panic rallies are loud. Fear is visible. This move has been methodical, almost patient, and that patience is what makes it harder to dismiss. Silver's behavior reinforces the same unease, pressing toward $120 an ounce, not in a sudden blow-off, but in a steady climb that suggests participation rather than frenzy. The false comfort many cling to is the idea that parabolic moves must end the same way, that every sharp rise is followed by a cleansing fall that restores order and confirms the old rules. That belief has been reinforced by decades of market history. But it also assumes that the underlying structure hasn't changed. It assumes that the forces pushing prices higher are speculative and reversible. What if they're not? What if the move isn't about excitement, but about recalibration? One of the earliest signals comes from how gold is being described. Increasingly, it's no longer framed purely as an inflation hedge or a crisis asset. Analysts are beginning to talk about it as a neutral store of value, something that sits outside political systems and policy cycles. That might sound like semantics, but it represents a profound shift. A hedge is something you use against a specific risk. A neutral asset is something you hold because you don't trust any single outcome enough to bet against it. This shift is reinforced by behavior, not rhetoric. Central banks have been accumulating gold steadily, not in response to panic, but as a long-term balance sheet decision. These are not momentum trades. They're structural choices rooted in sovereignty, diversification, and optionality. When institutions with the longest time horizons behave this way, it signals something deeper than a tactical move. There's also a quieter mechanism at work, one that rarely gets headlines: physical demand. In places like Shanghai and Hong Kong, buyers haven't stepped back in the face of record prices. Stores are crowded, demand remains strong. That doesn't fit the classic narrative of a bubble where rising prices eventually scare buyers away. Here, higher prices appear to validate the decision to buy, reinforcing the idea that waiting may be riskier than acting. Silver adds another layer to this story. Often dismissed as merely a cheaper version of gold, silver carries its own structural pressures. Analysts point to persistent market deficits and reduced availability of above-ground stocks. This means that incremental demand has an outsized effect. It also means that paper markets can become disconnected from physical realities for longer than expected, until they can't. At this stage, it's tempting to conclude that everything is simply expensive and due for correction. And corrections will happen. They always do. But focusing solely on price misses the more important question. Why are these assets being repriced in the first place? What assumptions are being challenged quietly, without drama? The delayed risk isn't an imminent crash or a sudden collapse. It's the slow erosion of confidence in predictability itself. Policy decisions that feel reactive rather than strategic. Inflation that cools but refuses to disappear. Debt that grows without a credible path to reduction. None of these are new. What's new is the market's willingness to treat them as permanent features rather than temporary distortions. History doesn't need to be invoked as a warning of catastrophe. It's more useful as a reminder of how systems behave during transitions. In past periods where trust shifted from institutions to assets, the process was gradual. Prices adjusted, portfolios diversified, definitions of safety evolved. There was no single moment when everyone agreed the rules had changed. The change was inferred from behavior. Second-order effects are already forming. As gold rises, currency dynamics adjust. A weaker dollar supports commodity prices, which feeds back into inflation expectations. Central banks respond cautiously, aware that aggressive moves carry their own risks. When rates are held steady, even as inflation remains above target, it sends a signal of constraint, not weakness but limitation. Here's the uncomfortable midpoint. If gold and silver are rising not because of fear, but because confidence is being redistributed, then traditional risk metrics become less reliable. Volatility can remain low even as structural stress builds. Correlations can shift quietly. The danger isn't that something breaks suddenly. It's that many continue to interpret what's happening using frameworks designed for a different environment. This is the moment where the narrative begins to change. Gold stops being a trade and starts becoming a reference point. Silver stops being an afterthought and starts acting like a signal. And the realization settles in that safety may no longer be something you activate in response to events, but something you reassess continuously. The next part forces a deeper look at what happens when that realization spreads, because once it does, the system doesn't snap back. It adapts. Once that adaptation begins, the market stops waiting for permission. It doesn't announce the shift, and it doesn't check whether everyone is ready. It simply starts behaving differently, and those behaviors compound over time. This is where many observers become confused, because the surface indicators don't match the underlying movement. Headlines remain dramatic, but not decisive. Policy statements sound confident, but leave room for interpretation. Prices keep rising, but without the emotional excess people expect. The result is a growing gap between what people say they believe and how they actually position themselves. One of the strongest anchors people rely on is the idea that central banks can always regain control. If inflation runs hot, rates can be raised. If growth slows, liquidity can be added. This belief has been reinforced for decades, and it still holds some truth. But control is not the same as precision. When inflation remains above target and rates are left unchanged, it reveals a constraint rather than a choice. It suggests that policymakers are balancing competing risks, aware that decisive action in one direction may destabilize something else. Markets sense this hesitation, even when it's framed as confidence. Gold reacts to this environment in a very specific way. It doesn't spike violently because there is no single moment of panic. Instead, it grinds higher, absorbing uncertainty rather than responding to fear. Each new high becomes less shocking than the last, not because it's justified by one event, but because the absence of resolution persists. The move past $5,000 an ounce wasn't met with disbelief so much as recalculation. Investors didn't ask how it happened. They asked what it meant. Silver's advance reinforces the same message, but through a different channel. Silver carries a dual identity. It is both a monetary metal and an industrial input. That duality makes it sensitive to a wider range of forces. Supply constraints, particularly the reduced availability of above-ground stocks, create a structural tightness that doesn't resolve easily. When investor demand meets that constraint, prices respond quickly. This isn't about speculative leverage alone. It's about physical realities asserting themselves over financial abstractions. Second-order effects begin to emerge as these dynamics persist. Rising gold and silver prices influence currency perceptions, not through collapse, but through comparison. When an asset consistently holds or gains value while currencies fluctuate, it quietly reframes what stability looks like. This doesn't mean fiat currencies fail. It means they are evaluated relative to alternatives more frequently. That shift in evaluation can be gradual, but it has consequences for capital flows and portfolio construction. Geopolitical tensions add another layer, not because markets expect immediate conflict, but because they increase the range of possible outcomes. When major powers exchange warnings and counter-warnings, the risk isn't only escalation. It's miscalculation, delay, and uncertainty about response. Even if nothing happens, the unresolved nature of these tensions encourages diversification away from assets tied closely to any single political system. Gold benefits from being politically neutral in a world where neutrality is increasingly rare. There's also a behavioral element that often goes unnoticed. As prices rise, narratives change. Early in a rally, participants look for reasons to dismiss it. Later, they look for reasons to justify it. That transition is subtle, but powerful. When analysts begin to suggest that pullbacks may be opportunities rather than warnings, they are acknowledging that the underlying drivers are perceived as durable. This doesn't eliminate risk, it reframes it. History offers guidance here, but not in the dramatic way many expect. Past transitions in monetary regimes rarely involved sudden collapses. They involved prolonged periods of adjustment where old benchmarks lost relevance and new ones emerged slowly. During those periods, assets that could function across multiple scenarios gained prominence. Gold's evolving role fits this pattern. It doesn't require a specific outcome to make sense. It only requires uncertainty to persist. Platinum and palladium movements, while less central to the narrative, still reflect the same environment. Platinum's surge to record levels earlier signals strength in the broader precious metals complex, driven by both industrial demand and investment interest. Palladium's relative weakness highlights how specific supply and demand factors can diverge even within the same category. Together, they remind us that this is not a single trade, but a reallocation across tangible assets responding to overlapping pressures. Another underappreciated factor is the involvement of unconventional buyers. When entities associated with digital finance allocate a meaningful portion of their portfolios to physical gold, it challenges old assumptions. Gold and digital assets were once framed as competitors, each claiming to be the future of value storage. Increasingly, they are treated as complementary tools. This convergence suggests that the core issue is not technological preference, but trust, or more precisely, the lack of it. The false comfort many still hold on to is the belief that this process will reverse cleanly, that once inflation cools or tensions ease, prices will return to familiar ranges and the old rules will reassert themselves. That outcome is possible, but markets are already signaling skepticism toward that assumption. The persistence of elevated prices, even in the absence of new shocks, implies that expectations have shifted. Stability is no longer assumed, it is conditional. This creates a subtle but important risk. Traditional indicators may fail to capture the buildup of structural stress. Volatility measures can remain subdued. Credit spreads may not widen dramatically. Equity markets can continue to function. Yet underneath, confidence is being redistributed, not destroyed, but reallocated. Assets that rely heavily on policy credibility are scrutinized more closely. Assets that rely on physical scarcity or neutrality gain appeal. The midpoint realization is uncomfortable because it doesn't offer a clear action or resolution. It simply changes how the environment is interpreted. Instead of asking when this move will end, the more relevant question becomes what assumptions it is exposing. Rising debt, persistent inflation pressures, and policy unpredictability are not new developments. What is new is the market's willingness to treat them as enduring conditions rather than temporary deviations. As this realization spreads, behavior adjusts further. Gold becomes less of a trade and more of a reference. Silver becomes less of a speculative side bet and more of a signal about physical constraints. And the concept of safety itself starts to shift. It is no longer something activated during crises, but something reassessed continuously in response to a world that offers fewer clear anchors. The next part pushes this idea to its logical conclusion. Because when confidence migrates quietly rather than collapsing, the consequences are subtle, persistent, and easy to underestimate. When confidence migrates instead of collapsing, the system doesn't give you a clean signal that something has changed. There is no single breaking point, no dramatic reset that forces everyone to update their assumptions at once. Instead, the adjustment shows up in small decisions, repeated quietly across millions of balance sheets. Portfolios tilt, reserves shift, language softens, and by the time people realize the environment is different, they've already been behaving as if it were for some time. This is why the question of whether gold or silver is too high starts to feel strangely outdated. High relative to what? To past decades shaped by different monetary discipline, lower debt loads, and clearer policy constraints? Or to a future that is still forming, where uncertainty is not an anomaly but a baseline condition? Prices don't answer that question directly. They reflect the aggregate discomfort of a system that no longer agrees on what normal looks like. You can see this discomfort in how policy decisions are interpreted. When rates are held steady, while inflation remains above target, the market doesn't hear reassurance. It hears limitation, not failure, but constraint. The acknowledgement that every lever pulled in one direction creates pressure somewhere else. This awareness changes behavior. Investors become less willing to rely on a single policy outcome. Diversification stops being about return optimization and starts being about regime resilience. Gold fits naturally into that mindset. It doesn't require growth, low inflation, or political stability to justify its role. It doesn't depend on earnings, promises, or counterparties. Its value is not derived from confidence in a system, but from its independence from one. That distinction becomes more important as systems grow more complex and interdependent. When everything is connected, assets that stand apart gain relative appeal. Silver's role, though often underestimated, reinforces this point in a different way. Its market structure exposes the tension between financial abstraction and physical reality. Persistent deficits and reduced above-ground availability mean that demand cannot always be met by paper claims indefinitely. When that tension grows, prices don't just rise, they communicate. They signal where assumptions about abundance no longer hold. This is why silver's move alongside gold feels confirmatory rather than coincidental. What makes this phase particularly challenging is that many traditional warning signs remain muted. There is no widespread panic. Credit markets are not seizing up. Equity indices may continue to function, even thrive. This creates a false sense of continuity. People assume that because the surface looks intact, the underlying structure must be stable. But stability is not the same as familiarity. A system can operate smoothly while still undergoing a fundamental reweighting of trust. History reminds us that such reweightings rarely announce themselves with clarity. In past transitions, participants often argued about whether change was really happening, even as they adjusted their behavior accordingly. The debate itself became a distraction. Those waiting for consensus usually found it only in hindsight. By the time everyone agreed the environment had changed, the repricing had already occurred. Geopolitical uncertainty accelerates this process, not through dramatic outcomes, but through persistent ambiguity. When relationships between major powers remain tense without resolution, the range of possible futures widens. Markets don't need to know which outcome will occur. They only need to recognize that predictability has diminished. In that context, assets perceived as politically neutral gain value, not because they offer upside, but because they reduce dependence on any single geopolitical narrative. The behavior of physical buyers underscores this shift. Continued demand at record prices suggests that for many, the question is no longer whether prices are attractive, but whether exposure is sufficient. That mindset reflects a deeper concern about purchasing power and preservation, rather than speculation. It's a quiet vote of confidence in the asset, and a quiet vote of caution toward the system surrounding it. The involvement of digital asset-linked institutions further blurs old lines. When entities built around innovation and disruption choose to anchor part of their reserves in physical gold, it signals a convergence of risk perception. This isn't about rejecting the future or embracing the past. It's about acknowledging that every system has vulnerabilities, and that hedging those vulnerabilities requires tools that don't share the same points of failure. As these choices accumulate, second-order consequences continue to unfold. Currency relationships adjust as capital seeks relative stability. Commodity prices influence inflation expectations, which feed back into policy decisions. Central banks, aware of these feedback loops, act cautiously, often preferring delay over decisiveness. This caution reinforces uncertainty, creating a self-reinforcing cycle that benefits assets positioned outside the policy framework. The uncomfortable truth is that none of this requires a dramatic catalyst to continue. It only requires the absence of resolution. As long as debt trajectories remain elevated, inflation pressures linger, and policy outcomes remain uncertain, the incentive to hold neutral assets persists. That doesn't mean prices move in straight lines. Volatility will appear. Corrections will occur. But the underlying logic doesn't reset easily. This is where many get surprised. They expect a moment when the narrative breaks, when prices fall sharply and confidence in the move collapses. But structural shifts rarely end that way. They tend to exhaust disbelief before they exhaust demand. Skeptics gradually soften. Supporters grow quieter. And the asset itself becomes less controversial, not because it's understood, but because it's accepted. The real risk, then, is not being on the wrong side of a trade, but being anchored to an interpretation that no longer fits the environment. When gold is treated purely as a crisis hedge, its current role is misunderstood. When silver is seen only as a speculative proxy, its structural signals are missed. And when stability is assumed to be the default state, the gradual erosion of predictability goes unnoticed. This doesn't lead to a neat conclusion or a definitive call. It leads to a reframing. Instead of asking what will happen next, it may be more useful to ask what has already changed. Instead of waiting for confirmation, it may be worth observing behavior rather than rhetoric. Markets often tell their story through action long before they explain it in words. As confidence continues to redistribute, the system adapts around it. New reference points emerge. Old benchmarks fade, and the meaning of safety evolves. The unsettling part is not that something is obviously wrong, but that so much still appears normal, which raises a final question that lingers without resolution. If stability now depends less on control and more on adaptability, then in a world quietly redefining trust, where does certainty actually come from?